Good morning, everybody, and welcome to WHEB's first quarter webinar. This will be the first webinar we've done as part of Foresight Capital Management. My name is George Latham. I'm going to be joined this morning by Ted Franks and T. Lee. If we just go to the next slide, we'll just hover for a moment on the obligatory disclaimer slide. We have clients dialing in from both the UK and from Europe. So please take note of the remarks on there, I'll just touch on housekeeping for a second before I hand on to Ted. So we expect to present for a bit over half an hour, and we'll leave plenty of time for questions, but we should be finished at least by 11 o'clock. You can email me or use the chat function if there are any technical issues, and do use the Q&A function to ask questions. As I say, we'll try and leave plenty of time for questions, and if we haven't had a chance to answer all of them, or if you haven't had a chance to ask your question, then please do email and we'll come back to you after the event. Just to note that the webinar is being recorded, and we will send out a link to the recording and post it on our website after the event, as well as a copy of the slides. So without further ado, we'll move on to the agenda. This morning, Ted is going to give us a bit of background in terms of the global market context. No surprises in terms of where that's going to be focused this morning. T. Lee will then come on and do the strategy review, and then hand back to Ted to look at to go through the outlook. So with that, I'll hand on to Ted. Thank you.
Thank you, George. Hello, everybody. I hope you're all well, and thank you for tuning in to our webinar today. As George says, I'm going to open with some global market context, then T's going to do the sort of bulk of the reportage. And then hopefully at the end, I'm going to give you some reasons to be cheerful, because you might imagine what's about to follow is not particularly cheerful. There we are, straight away, the image of the reason why the challenges are here. Now, in the last webinar we gave, which was at the end of January, just after the inauguration, we observed that the Trump administration had kind of 5 key areas that we could identify, which would potentially be challenging for our strategy and for sustainability. It's fair to say it's set off at a pretty significant lick. I think if we sort of had a base case of how active and aggressive we thought the administration was going to be, it's probably exceeded that even in this period. Now we are a developed market strategy, and the US is such a big part of the global economy that obviously this is particularly relevant for us as well, it's worth saying. Even amongst the many things which the administration has done, the highest profile and certainly most important for financial markets has been the potential introduction of some pretty severe tariffs and kind of the initiation of a reset of global trading patterns, which I think you could describe as a trade war to start off with. Obviously, that's come forward and back a little bit. There's been some level of anticipation in the quarter that we're talking about. It was the sort of drumbeat of what would happen. Liberation Day, as named by the administration themselves, came on the 2nd of April. You can see that picture there of Donald Trump holding up the card of all the tariffs that were going to be applied around the world, including to some pretty remote spots, such as the McDonald Islands. On the right-hand side, the Yale labs have put this in some context. Now, this is from the 15th of April. Of course, this is all moving fairly fast, but at that stage, the implied cost of all the tariffs is that little green uptick you can see there at the end of that chart. This chart is the real impact of tariffs, so it's customs takings as a portion of total imports and projected, therefore, in the future period. But what you can see, the message is fairly clear. In the post-war period, we had a broad global consensus about free trade. You saw very low tariffs. Before that, obviously, going back through history, back to 1790, tariffs were used in different ways. Of course, trading patterns were much different then. And what we're seeing here is really quite a stark potential return to a completely different global landscape. And unsurprisingly, that's roiled markets. Now, we have said to our investors, really since the first kind of shots of this kind of emerged in 2015 and 16, as sustainability and impact investors, we invest in a lot of companies which have pieces of intellectual property which help solve sustainability challenges. They're inevitably pretty global in their reach. We have pockets of the universe which are not and are domestically focused, but really we are into globalization. We think these global challenges require a global response. So broadly speaking, this is a challenge for impact and sustainability. It's also a challenge in a slightly different way from a macroeconomic point of view, and that's because it's hitting confidence. Again, investing in solution sustainability challenges is really a growth activity, not uniformly, but broadly. So these are companies, the companies we invest in provide products that other companies buy as part of their investment plans on a long-term basis to try and see emerging trends that they can address with their own products in due turn. And so it does do better under periods of confidence. And what's happening now with all these dramatic shifts and the potential for this sort of ongoing global conflict is we're seeing a bit of a crisis of confidence. The right-hand side of this slide has got the headlines about Trump attacking the chairman of the Federal Reserve. Central bank independence, particularly US Federal Reserve independence, is really important for economic confidence and obviously the confidence of financial markets globally. So that's a pretty profound thing to have done. Some of the other moves we're seeing as well, which may infringe on which look like they're infringing on the rule of law, are not particularly helpful on that front either. And therefore, it's no surprise you see on the left-hand side, this is one gauge. This is the Chief Executive online magazine takes its regular poll of Chief Executive confidence. And you see that dropping fairly rapidly in this period. So these are kind of broader macroeconomic challenges from this very kind of explosive start to the new administration. But turning now to some slightly more sustainability specific points, and again, if I refer you back to the kind of 5 headings from the previous webinar, which were kind of trade, cleaner energy, electric vehicles, the healthcare complex, and also government efficiency. Well, taking 2 of those on this slide here, which is cleaner energy and the healthcare complex, the left-hand side is the specific memo from US Secretary of the Interior, Doug Burgum, which was to stop any further development of the Empire Wind offshore wind farm in New York. That is a bigger deal than the individual circumstances suggest, because that wind farm was, first of all, under the auspices of New York State rather than federal development, and it was also fully permitted. So this is a retroactive piece. Strikingly, of course, for an administration which prides itself on being deregulated into deregulation, this is a remarkable piece of regulation. They've gone in and said, just stop doing that without really any cause or explanation. So that gives you some sense of how challenging renewable energy development in bits of the US will be from this point. And it follows more orderly, but at the same time, still fairly extreme measures about the US. Now, as we've said in previous communications, that is just the US, and there's also some texture to that, as we'll come to onto in a moment, but it's a pretty stark start. And then moving on to the healthcare side, the chap whose picture graces this presentation is Peter Marks. He was a senior person in the Food and Drug Administration in the US. I think his role exactly was the head of biologics evaluation and research. I think most latterly, he's a kind of 10 to 15-year veteran of the administration, and he most specifically headed up the vaccine function, and he's been summarily removed by Robert F. Kennedy Jr. As the new Secretary of Health and Human Services, or rather, he was invited to resign. His resignation letter is on the right-hand side. If you have time to have a look at it, it's fairly fiery. What he represents is an established body of scientific process around new drug discovery and authorization. And what we're seeing here is a removal of a broad swathe of individuals like him at the top of that organization, and quite a different approach to how drugs are going to be researched and approved, apparently in the offing. And you can see other signs of that as well, particularly in the vaccine area, which is particularly important for our Robert F. Kennedy Jr. There's been this case of Novavax's COVID-19 vaccine being refused on non-scientific grounds, as far as we can tell. But all across that complex, not just on vaccines, there's this great uncertainty now. And that obviously, for a strategy like ours, which has got a very sort of heavy healthcare, 25% or more weight, that's obviously something of a challenge, and a challenge for anyone trying to provide solutions to some of the great healthcare challenges at the moment. The last slide on this little section then, whilst we're still unfortunately giving some of the backdrop, which is pretty tough at the moment, going into more detail though about some of the other bits of sustainability which the new administration is not into, it's fair to say. We did highlight the potential impact from the Department of Government Efficiency and the big regulatory rollback. There's a sort of broad reaching Executive Order 14129, which is directing all of the US machinery of government to try and reduce regulation. Of course, as previously commented, it seems to be regulation they dislike, but that's a separate point. But the striking thing about it is just quite how far-reaching it is. So the 2 pictures here on the left-hand side tackle 2 hazardous chemicals which are of particular interest to us, or not particularly interesting, but they certainly come up in our work because obviously they're particularly relevant to the environment. One is PFAS, the so-called forever chemicals, perfluoroalkyls. You've heard us talk about them before. We've written about them this quarter as well. They have some very valuable properties, particularly in fire retardation and other areas, but they were introduced before it was properly understood what their impact on the environment would be, and that impact is extremely negative, and consequently they need to be regulated very carefully at every point from manufacture through to use. And then the second one is ethylene oxide. Now, ethylene oxide is a gas which is used in sterilization. It actually does things in sterilization which it's hard to do otherwise. One of our companies, Steris, is a big sterilization company and uses ethylene oxide. We've talked to them extensively about it. It is definitely a chemistry which provides a solution, but it has to be hugely carefully managed because, again, it's very hazardous. Now, there is a general sense about how PFAS and ethylene oxide should be regulated. There's a general broad scientific consensus that needs to happen, and we need to be on top of this, and it's an emerging area, and plenty of our companies are providing solutions to it. The new administration appears just to be bent on rolling back those regulations. So a blanket idea that hazardous chemicals don't need to be regulated as much as they currently are is really at the far end of what we anticipated would be feasible for any kind of government anywhere to do. So it's just highlight just how extreme some of these moves are. And then on the right-hand side, this is another story. And by the way, many of these stories, I'm sure you guys are aware who are watching markets, they come and go fairly rapidly. So this one in the last couple of days, I think seems to have gone perhaps into abeyance, but there was definitely a move afoot to change the charitable status of environmental NGOs and charities. And again, it's that kind of pinpoint activity to really go after some of the key kind of sustainability causes which we think you as investors are interested in, which makes this particular moment quite challenging, really, in terms of the sentiment towards our stocks and also the economic future they face. So I'll pause there because that's not a happy 4 slides to open with. But I promise you later on, I'm going to come back and we're going to talk about some of the reasons to be cheerful and why this isn't as bad as it seems. In fact, why, from an investment point of view, it's quite a good time to start to be interested. But that is the report for the first opening salvos of the Trump administration. And with that, I'll pass on to T.
Thank you, Ted. Let me share my screen. Yes, so I'll start by setting the scene with a few key macro developments. The market in Q1 was heavily influenced by growing concerns over the potential impact of US tariffs. And these concerns intensified throughout the quarter, leading to increased market volatility. As you can see on the left, the volatility index, often referred to as the fear gauge, spiked to levels not seen since the COVID-19 pandemic. And this sharp rise was triggered by Donald Trump's announcement of sweeping tariffs, which sent shockwaves through the market. And this uncertainty was also reflected in commodity prices, as shown on the right. Oil prices have been declining throughout the quarter due to concerns of a broader economic slowdown. And they fell sharply on the date of the tariff announcements, reaching a 4-year low. In contrast, gold prices surged to an all-time high as investors sought safety in traditional haven assets. Concerns over tariffs also had a similar impact on commodity prices. On the equity markets, defensive sectors outperformed cyclical ones throughout the quarter. Likewise, value stocks outperformed growth stocks due to growing concerns of an economic recession. Market sentiment has pivoted away from optimisms around lower interest rates and is now more focused on the rising risk of a global economic slowdown. The Magnificent Seven stocks were also caught up in the recent market turmoil, posting the worst quarterly performance in recent memory. After the quarter end, the tariff announcements triggered an indiscriminate market sell-off across investment styles, as you can see on the right. And this broad-based market weakness, however, created investment opportunities. Many high-quality companies with very limited direct tariff exposure was caught in this sell-off, presenting compelling value opportunities for long-term investors like us, which we'll come on to in the outlook session. Getting to our strategy performance, as explained in our recent monthly article, we removed MSCI World as the benchmark, as our investment universe had little overlap with the benchmark. Instead, we are now showing our performance in the context of a broader set of investment alternatives that our investor typically would consider, including equities, bonds, and cash. And given the unique nature of our strategy, we think the best way to understand our performance is through contribution to return, which is covered in the next slide. Look at the contribution to return by theme. Our two largest themes, resource efficiency and health, were the largest detractors. The resource efficiency themes include a number of industrial companies, which tend to be more cyclical. And given the volatile market condition, its weaker performance was somewhat expected. On the other hand, our health themes tend to be more defensive and would normally be expected to hold up better in this kind of environment. However, our holdings in the life sciences tools companies did not perform as we anticipated, which I'll come on to shortly. On the positive side, our education theme held up better in the volatile market. In the next couple of slides, I will take you through what's behind these thematic developments in more detail. Our resource efficiency theme was the worst contributor, within which our automation companies remained weak. Many businesses here have been working through the excess inventory following the supply chain normalization and weakened end market demand. A major vertical for many of these businesses is the automotive sector, which has faced additional headwinds due to challenging macro environment and the deceleration in EV growth. Recent quarterly results suggest these companies may be at the trough of the cycle, with market previously anticipating a gradual recovery this year. However, concerns over tariff has now cast doubt about the pace of that recovery. As you can see in the global manufacturing PMI chart on the left, activity has hovered around the 50 mark for over 2 years, suggesting a prolonged period of stagnant growth in global manufacturing and by extension in automation demand. And this also reflected in the top 9 growth trend of the automation companies, as shown on the right, which remains subdued in recent quarters. On the positive side, our education theme was the best contributor. Historically, the US education sector, particularly for profit education providers, tend to perform well under Republican administrations because they are expected to face less regulatory scrutiny. And that dynamic also played out in this quarter following the US election outcome. In addition, many of these businesses are largely insulated from tariffs, which made them attractive as a relatively safe haven. One notable development in this quarter was Trump's executive order to dismantle the Department of Education. However, the market reaction was muted, and there are a couple of reasons for that. First, Trump cannot unilaterally shut down the department. Doing so would require a supermajority in the Senate, which remained unlikely. Second, the market is naturally focused on the future of federal student aid, and it's announced that the student loan portfolio will be transferred to the Small Business Administration, which help ease concerns. So these factors probably explain why the market hasn't reacted much, despite headlines making it sound dramatic. Looking at the individual stock contributors, the positive contributors have one thing in common. They are largely defensive or mostly less impacted by tariffs. For example, AstraZeneca and Steris are both healthcare companies, and American Water Works is a water utility. On the other hand, it's harder to pinpoint a common theme among the negative contributors. Their underperformance was driven by a variety of factors, and in the next few slides, I'll cover the top 2 and bottom 2 contributors in more detail. The worst contributor in this quarter was Smurfit Westrock, which is a global leader in paper-based packaging. Its share price came under pressure this quarter due to concerns over potential trade disruptions in two areas. First is Mexican business, which accounts for mid to high single digits of its net sales. While the majority of this business is domestically focused, tariffs are expected to affect its customers who export the finished goods to the US. Second, there are concerns over its paper mill in Canada, which may become uncompetitive under the new tariffs. However, the actual impact is likely to be limited, given that that paper mill only accounts for 1% of its total production capacity. And the company already has contingencies in place. Looking at the fundamentals, the company has strengthened its global leadership in sustainable packaging after acquiring Westrock in July last year. Smurfit, even before the merger, was a really well-run business with a very strong track record. So we believe it has the capability to improve Westrock's operational execution and unlock its potential commercial opportunities. The company is on track to deliver $400 million synergies by the end of this year and has identified another $400 million potential synergies from operational and commercial initiatives. So overall, we believe the market has overreacted to the tariffs news, and the current share price does not reflect Smurfit's long-term growth potential in sustainable packaging.
Agilent, one of our life sciences tools companies, had a difficult time in the first quarter. It provides a range of products and services really around drug discovery. It leans particularly heavy into the academic sector and also into applied markets, such as industrial markets. It does have, amongst the life sciences tools companies and amongst American companies in general, a relatively high exposure to China. So obviously faced a tariff headwind, it's got Chinese exposure, which is something sort of up to around 20%. But you can see the chart on the left-hand side. The life sciences tools companies are caught in this challenge, both of the trade wars and their very international footprint, but also, we mentioned before, the changes at the Food and Drug Administration. What we're interested in Agilent, of course, is that it's actually had a longish period of muted demand, and we're starting to see that improve now at the moment. Anyway, we've had prints already in this first quarter from its peers, Danaher, Thermo Fisher, and Sartorius, and we can see that growth is there as we anticipated. It's also got a very broad range of products, and as we mentioned before, the solutions to the PFAS challenge, that's an area Agilent is kind of leading as well. So it has a number of quite interesting growth opportunities ahead of it. It's also got a margin expansion program, but it certainly has been hit by the sentiment in the first quarter. Switching over then to the companies which did rather better in the first quarter, the top of that list was AstraZeneca, the UK pharmaceutical company. Worth noting that after the quarter, of course, you guys who, particularly the UK investors, will be aware that it did get caught up in the tariff announcements after the end of the quarter. But in the first quarter, its relative defensiveness, and particularly the reason that we invest in it, that it has this very catalyst-rich pipeline, was really working for AstraZeneca. It was also recovering, as the left-hand chart shows, from an investigation in China, which now seems to have reached some level of stabilization, although, of course, you can never be quite sure there. But most importantly, it's starting to see the readouts on some of these big drug trials of different phases coming through this year as predicted, and the sort of core investment thesis there for AstraZeneca seems to be in pretty good nick. And then lastly, on the stock side, American Waterworks, a US water utility, again in troubled times, demonstrating good defensive qualities. It's quite an interesting company, American Waterworks. Obviously, we try and find companies where there's an additional impactful angle. American Waterworks, as well as consolidating smaller and less efficient utilities, it's a big program about making those utilities more sustainable in its own interests, therefore to be able to be more efficient in the water it provides to its customers, and it has been able to deliver this very solid long-term growth path as well. So successful American Waterworks in the quarter. So again, I'm keeping my eyes open in case anything is going on at my side, and George and others do jump in if my sound goes as well. But in the meantime, we're going to switch back to the outlook part of the presentation. And when I left you before T stepped in, I'm hoping people weren't too sort of despairing of the current situation. I'm now going to go through reasons why it's not as bad as it seems on the ground, and also from an investment point of view, there are reasons to be more interested now, in fact, than there have been at other times. Now, the first thing to say is that this too shall pass. So the strategy's got a 20-year history. I've been involved in running it for more than 15 years. We are obviously aware of political cycles. They're more extreme now than they used to be. I think that is something we have to own, but they are still cycles. And American presidents are absolutely at the height of their political powers just after they're elected. They then have political capital which they can spend on their key topic areas. And at the point at which it's spent and the political winds change, then obviously they reach the limit and you go back to a sort of more stable negotiated position. This administration has set off with a very rapid clip on a very broad waterfront of changes it wants, and many of those are impacting people all over the US and in fact around the world. And so that capital is going pretty quickly. Moreover, it comes from a particularly kind of uncertain starting point. Now, this is the relative net approval of US presidents. It's excellent data collated by Nate Silver on his new website, Silver Bulletin, which I recommend to everybody. These are the most recent US presidents. Before this, in happier times, net approval ratings were even higher because things were less partisan then. But you can see, even in the context of recent presidents, this new Trump administration is only more popular than a single previous administration. That's Trump's first time around. And moreover, he's dropped in popularity far more rapidly this time than he did in the last time. And that, of course, will tell, and it will take its toll on the ability to force through on all of these agenda points that he would like to. And it will also, at some point fairly soon, result at least in something of a reduction in the slightly sort of chaotic way that this is being conducted. So, absent there being, and there is of course a risk that this will result in a kind of severe economic dislocation, I think the more likely thing is that we get to a point where we start to see some better contours of what is possible and what is going to stick from the big agenda. And when that does happen, I think it's worth sort of pointing out that with sustainability and impact investing, as we've outlined a number of times, and hopefully you guys who follow us closely, having that sort of overweight to economic sensitivity, we've got fairly significant bits of the portfolio that were just getting ready for kind of an upswing. The third quarter of last year looked like it could be a trough in terms of organic growth. This is on the kind of automation side, around automotive and industrial applications, and also around our life sciences tools names, all of these ones which were looking for a bit of a recovery in confidence. You can see that the longer term track record here, as indicated by the purchasing managers indices, was not as though we were coming from a particularly high position anyway. We've been kind of bumping along the bottom here for a number of years. And so our view is that the balance of that probability is probably to the upside if we can get some level of stability, and particularly if the Trump administration goes on to try and introduce one of its kind of signature landmark promises, which is around tax cuts. You could see a potentially strong kind of snapback. Now, of course, there's still also the possibility of recession in the picture there, but we would say it looks as though, although it's delayed, there is still the potential for a lot of these industries to take a boost. Moving to a slightly more structural tone, then, a couple of thoughts on that front as well. The first is that actually, with no political agenda is completely short of things which that certain groups can get on board with. One of the key points about our investment strategy, which is trying to invest in companies in developed markets with kind of high governance and ESG standards, really led by good intellectual property leadership, and then with a sort of global basis. We've obviously had a challenge for a number of years with the growth of competition from countries with strong industrial policy backing, and the most obvious one of those is China. Now, there's a couple of things to say about industrial policy. The first is the pie chart on the left-hand side, which you've seen before from me, just identifying and noting that not all industrial policy is about competition and sort of zero-sum trade wars. It also can take the form of industrial policy to support sustainability causes, as we saw, of course, most notably with the Biden administration and the Inflation Reduction Act in the last administration. So to some extent, the emergence of industrial policy is not something to be totally negative about. Now, on the right-hand side, there's this very key point about leveling the playing field. So A lot of what China has done, and notwithstanding the sort of other global currents around it, but a lot of what China has done in the last 2 decades has been a very targeted nationalistic approach to commerce. And that has been damaging for Western economies. Now, a lot of that would have been inevitable to do with different comparative advantage in different markets. But you can see here in the chart on the right-hand side, that industrial policy spending in China is far greater than in the rest of the developed world. And on top of that, you have the regulatory, legal, and indeed social kind of context of it. So any kind of measures here to prompt a global rebalancing and provide a more level playing field for the equity value creation that we want to see could potentially be something in the silver lining. A bigger structural point, though, and a bigger reason to be cheerful, is just the sheer weight of economics now behind a lot of the sustainability themes that we try to invest in. And that is to say, many of these technologies are proving to be much cheaper, not just over the long term, but even the short term, than their less sustainable counterparts. And a key area to look at this, of course, is in renewable energy. And there is the most wonderful example of it at the moment from the very Republican state of Texas in the US, where there's been a remarkable development over the last 5 years. And you can see that here on the chart on the left-hand side. There are your capacity additions to the Texas power grid, which is run by an organization called ERCOT. You can see in 2020, you have that mix. It's got a lot of natural gas in it, some other sources, and then already by then, there was a significant wind presence in Texas. But in the last 4 years, the additions have really been solar and also critically battery storage. And that's not an accident, because to bid into the ERCOT grid, it's just done on cost alone. So these technologies, which are now lowest cost technologies, have been increasingly adopted. And the remarkable thing about that as well is it has resulted in a state which very notably you may remember in 2021 had Winter Storm Uri, which caused widespread blackouts and chaos in terms of power provision. Now those blackouts came in fact because the fossil fuel assets, coal and gas, froze up and weren't able to service the grid. The response to it has been a green response, and particularly with the battery storage piece, it's resulted in a cheaper and more stable grid. So it's been a kind of universal economic success story for renewable energy. And yet, as politics intervenes, we now have these bills in front of the Texas legislature on the right-hand side, which seek to really handicap the further development of renewables kind of by any means necessary and completely in the face of the economics of the situation. So you guys can have the slides after the presentation, you can read in your own time, but quickly, Senate Bill 819, you need 3,000 feet between the nearest dwelling and a wind farm now. You need 0 feet between the nearest dwelling and a fracking plant. So it's completely imbalanced. And Senate Bill 388, the proposal there is in a way more remarkable. They're asking for every piece of power generation that goes into the grid to be matched by dispatchable power, which is a sensible response to potential risks of intermittency. But the most dispatchable power, of course, is battery storage, and that's been specifically written out of legislation as not qualifying. So this is a remarkable boost for fossil fuels, and it's really very telling as well because it represents something like King Canute trying to force the tide back. But of course, King Canute realized he couldn't do that and was trying to demonstrate that. Whereas what's happening here is that the advocates for fossil fuels seem intent on forcing us to use that technology, no matter what the economics are. So with the economics now very much on the side of green technologies, and you can see this globally, this next slide in terms of those adoptions moving beyond Texas, but sort of globally as well. Very good data from Bloomberg New Energy Finance here. Left-hand side, energy transition investments as a share of GDP continuing to rise. And the right-hand side, the corporate buyers of energy continuing to break new records, the amount of clean energy buying they're doing. The message here is very clear that the underlying economics are inexorably moving in favor of sustainable solutions. And so this very noisy attempt to push back that tide, to us, seems as though it's fundamentally doomed and kind of validates the power of the case on the other side. Switching from what's going to happen on the sort of macro and fundamental point to what we can do as investors, a few last observations to leave you with before we sort of wrap up and go to questions. The first is to say, not everything that we do is economically sensitive. We have a universe and a portfolio which includes some companies which are less impacted by it. Here around the wagon wheel, we've got examples of companies which in this period have done relatively well because of their defensive qualities. We've talked about American Waterworks already, Linde and Ecolab. They're larger industrial names, but they also have more defensive sort of business models. So we have that optionality as well. And we do try and build it in. We've always tried to have a kind of risk balanced approach. And of course, there are areas where the growth is still untrammeled, unchallenged. Grid expansion, we've talked about the case of Texas. Texas is a good example also, because it has a very dramatic load increase projection, i.e. lots more people demanding electric power. That is matched around the world. It's not just AI data centers, but it's also the electronification of everything. You can see on the left-hand side here, the grid build out. We do have companies which are involved in trying to make that more efficient and green, such as Schneider Electric. And then the other, ongoing growth area, of course, climate change doesn't stop. The expense of adapting to it increases, and we have plenty of investments which look at adaptation as well, and are untouched by some of this very noisy kind of policy backdrop. And then the final point, which is, I guess, a key point that I'm trying to make sure all of our investors and potential investors understand, is that these are fundamental moves, and also some of the things we can do from a portfolio management point of view. It does remain the fact that our portfolio and also our universe at the moment is just remarkably cheap, because the sentiment has swung so dramatically against it. Here is our price to book ratio chart, which many of you will have seen before. It's still in the same position it was. We're probing new lows, certainly over 10 years. I think historically, even with a very long track record, it just looks extremely cheap now. And going on looking at it through a different valuation metric, price to earnings, it's the same story. And this slide as well, we've included a little bit of some of the broader universe numbers. Look at some of those sub-themes, solar power and so on. You can see the current price to earnings ratio for the next 12 months, and then what the 5-year average of that's been. And remember, that 5 years does include still some of the peaky kind of multiples we saw around 2020. And even then, we've got these big discounts. So the opportunity for a patient investor now is probably as good as it's been, because the sentiment is as low as we've ever seen it. Clearly, we are thoughtful about the timing of this, the catalysts, but I think if you have a long-term horizon, this is a really interesting time to invest. So thank you very much for taking the time to watch. Here's the disclaimer, and we'll see you again.